Hello everyone, I'm Ed Porter and welcome to a one-off session running through a keynote speech from the Energy Storage Summit in London on the 24th of February. We're going to run through multiple markets and key trends in the battery storage space. Let's jump in. Let's run through the changing role of storage in power markets. When we've spoken previously at energy storage summits, it's gone something like this. We've taken a region, in this case, Germany, and we are looking at the growth of batteries in this area. And so here we have Germany getting close to 8 gigawatts by the end of 2027. And this is pretty common across all markets. So battery tech is good enough that in most markets, the growth looks something like this. So a slow start and then a reasonably quick ramp as more assets are coming in. From an energy perspective, we have an energy capacity perspective, we have Germany getting towards 16.4 gigawatt hours by the end of 2028. If I just go back to rated power in gigawatts, one thing that's quite noticeable is that we got to around about 2.4 gigawatts by the end of 2024. That number had previously been forecast to be 3 gigawatts, and what tends to happen is that the actual delivery runs behind the deployment of batteries, and that's because delays happen on site, problems occur. But the main message here is that batteries are coming. And when batteries do come, they saturate the market. And what that means is that many batteries, when they first enter a market, they will capture an ancillary service revenue. And that typically is very well paid because it's historically trying to pay a very non-flexible unit like a gas unit to do something like respond very quickly. And it doesn't like to do that, and so it likes to charge more money for that service. And so what we're seeing here is that when batteries first come into a market, so to take Texas, for example, they will go into the ancillary service markets and they will push in that market first. Eventually, what happens is that you have enough batteries in that market that actually batteries need to start looking for an additional service. So let's say you've got 2 gigawatts of ancillary services. Once you have more than 2 gigawatts of batteries, what happens is they compete on the price for ancillary services until they meet the next best market. And that next best market is usually energy or wholesale trading. And so what you're seeing in those markets that are saturating is that essentially the portion of energy trading is going up in time. And when you get into that energy trading world, things become in a sort of a classic energy structure, they're around supply and demand and the overbuild or underbuild of different technologies. So here we have a view of what the price in 2030 might be in Germany with a 10% overbuild or a 10% underbuild of battery storage. And so it's all the things you would expect, which is that if you build fewer batteries, you have lower peak prices in the morning, lower peak prices in the evening. But for solar groups, there's a really interesting part on this, and I'll come back to it later, which is that if you build lots of batteries, one thing you do see coming through is a much higher price in the middle of the day, when historically those prices have been forecast to be very low. And that's because if solar dominates those periods, you can get a very near zero price coming through. And so wrapping up on a specific region, in this case, Germany, one thing that we would highlight again and again is that when markets saturate, and as you add many more batteries to these markets, the revenues that come through initially from frequency response or from ancillary services, they do come down quite quickly. And so if you're thinking about the future revenues for a region like Germany, you have to think about those fundamentals of how are you going to be dispatching that asset over the long term. And so here's a snapshot of what a central forecast might look like for Germany. But this future is really hard to predict. And this can be in a few ways. In one case, and going a bit left field, this is a quote from Spotify, a software company, who haven't touched a line of code since December. Now, they don't mean that. They mean they haven't been writing software code since December. Essentially, they're using AI tools to write code significantly faster. And sticking on this theme, if you want to be thinking about AI in energy, it's a really hard thing to be really comfortable with. One thing that I couldn't do at the Storage Summit because of Wi-Fi, but is always great to do, is to show you how this works. So I'm going to go across to the Modo terminal now. I'm going to open up our AI Analyst, and I'm going to ask it a question, something like, what does an investor need to know about investing in German batteries. So here we go. We have a comprehensive investor guide to German battery storage. It's one of Europe's largest electricity market and fastest growing. We have here the market size and growth. And we also have the revenue stack. So where are batteries making the kind of key returns? Some key risks around grid connections, flexible connection agreements, including ramp rates, revenue saturation and overbuild, things like the role of gas in the market, site selection, co-location. And if any of these things are particularly interesting, then you can come off the AI Analyst and go across to a part of the terminal and read that in more detail. And that's something that would be written by one of the Modo team. Okay, let's get back into the presentation. So that was the AI Analyst. And let's look at another key part of the system that's changing. So here we have demand growth, and we're looking at the change in demand forecasts over the years from GB's system operator. And this is really hard to get right because we know that at some point demand growth is coming, but it's hard to know when. And this is coming because we're electrifying transport, we're electrifying heating, and data centers are coming onto the system. But when demand comes, we can't click our fingers and have generation on at the same time. We have to be cautious and build generation ahead of that demand coming online. And so the market will get quite lopsided if the demand doesn't come, because the generation will be built, but the demand won't arrive. And so what's quite reassuring in this chart is we are now starting to see that demand turning. If it's slow, but if the shape of some of those forecasts are to be believed, this could be quite interesting over the next few years and a really key driver of future battery revenues. If you don't get demand coming through on a system and you add lots of generation and lots of battery storage, like in Texas, you can see here the change in revenues since 2022 down to 2025. And those revenues in 2025 are particularly low. They are probably not revenues that would encourage anyone to come into the Texas market and build battery storage, except those are only for a point in time. And so similar to the chart that we just looked at for GB, let's look at demand projections for Texas. And here in blue, you can see the sort of two forecasts from ERCOT and then one red forecast from the Modo Energy team. And what we're seeing here is a pretty big growth in demand over the next few years. And if those demand forecasts come through, then all of a sudden you have potential for much more peak pricing coming through in Texas, and that will make for a significantly better market for battery storage. So another example of how important demand is. And in those energy-only markets like ERCOT, if you don't have that volatility or you don't have demand growth coming through, then they can be particularly low revenue. And so that's perhaps a sort of pessimistic side to what we're seeing globally. On the positive side, here we see the net load in CAISO, so that is California. And California has a lot of solar. And what we're seeing is the classic duck curve. So essentially every year where more solar is being added, that net load is getting lower and lower. And really the role of battery storage is to shift that excess solar from the middle of the day into the evening period, or to take energy from overnight and use it to address that morning peak when people start to get up and put the kettles on. And there's a bit of an Easter egg in here as well, which is to say that in some periods, that CAISO ramp of demand towards the end of the day is quite severe. And so you might be adding something like 20 gigawatts in a few hours. That's very difficult to manage as a system operator. And so it's another thing that we expect storage to be used for in the long term, managing those very large swings in ramp rates. Going beyond the fundamental demand shape, let's look at the revenue. And so here we have, in Spain, we have the revenue that solar is receiving, and this is as a percentage of the baseload price. So if we go to 2021 or 2022, we have solar getting something between 90 and 100% of the baseload price, which is good. As we've added more solar to the system in Spain, and now we have something like 35 gigawatts in Spain, you can now get to the point in the middle of the year, let's take May, where you might have a capture rate of between 10 and 20%. And what that's saying is that if the base load price was 50 euros, that solar site might only be getting between 5 and 10 euros for the generation. And that makes it really hard as a group looking at solar to keep on investing in that technology without having something else on that site that can make better money when the power prices get very low. So if your power prices get very low in the middle of the day, okay, your solar's not making much money, but that's good news for your battery because it can charge and it can shift the energy to a peak price period and offset a gas unit. And so what we're seeing here is both a technical need for batteries, which was represented on the Californian chart previously, but also a commercial need. As solar becomes over-deployed in some regions, then we have this burning commercial need to bring through battery storage systems as well. But the challenge here is variable by region. And so if you're in somewhere sunny where the peak load coincides with a warm, sunny period, for example, if you have a lot of air conditioning, then in New South Wales, at the bottom in ERCOT, so Texas or COSO or California, often the system stress period is between 2 and 8 hours. And that's something that I'll talk about in a second, but is definitely something that battery storage can help to address. On the top two, you have Germany and Great Britain, and those systems, they tend to have system stress in the winter when the solar's not so strong. And so actually their periods of system stress, they tend to be slightly longer duration. And so you can see on this overall graphic of system stress, for those wind-dominated and winter load periods, you are getting system stress coming through for periods that's longer than, say, 12 hours. And that means that in Germany and Great Britain, it will be harder to meet those periods of system stress. Let's talk about what batteries can do today. So now we're flipping down to Australia, and I promised a bit of a global tour, and we are going around the globe here. But this is looking at recent LTESs that were run in Australia, and they are essentially auction processes for longer term energy storage. And on this far right-hand side, in sort of LTES around 6, we had around 12 gigawatts of lithium ion that was procured. And what's interesting about that lithium ion was that it was procured up to 11 and a half hours in duration. So if I kind of come back to the previous chart, if you're wondering where lithium might be playing, it'll certainly be in the 2 to 4 hour bucket as well as the 4 to 8 hour bucket. There is then a big question as to how do you deal with these 12-hour plus challenges. And we have a few research pieces on other technologies that's out there, but I expect there'll be some combination of your wind or solar, your batteries, your gas units, your nuclear that will be running in those periods as well. So there will be a combination approach to dealing with those longer periods of system stress. Okay, so those are some of the consistent themes that we're seeing driving storage business cases globally. But I wanted to get on to where do we see additional value coming through. So looking at 5 cases from the terminal, here we have one on voltage control. And so this is effectively looking at the blackout that came through in Iberia. And so you can see that going into May. And what you can see is that after the blackout happens, on this chart we have, in grey, we have the sum of energy dispatched from thermal units, and then we have the price paid for that. And so what you can see is that after the blackout, we're seeing many more thermal units being dispatched to support voltage control in Spain. And that is a market that with inverter technology advancing for battery storage, you can see more batteries entering these markets. And so that's another region where batteries can get additional revenue for providing additional services. I really like this chart in particular. This is looking at France, obviously, and it's looking at a part of their grid code. And it's looking at grid rates here. So each node has been identified as either an injection or a consumption node. And essentially what it's saying is, if you're an injection node and you are trying to put more energy into the system, and that system's already having a lot of injection going on, then you're going to be paying more for injecting in the middle of the day, and that's going to cost you more money. On the consumption side, so you're a demand region, and obviously you can see Paris right at the north there. If you are consuming lots of energy during those peak periods, then you're going to be paying more for consuming from the grid at those times. And the reason why this is really important is because it essentially encourages each node to act in a way that helps the overall system. If you don't have this type of pricing set up, then effectively you will allow the system operator or the groups planning the transmission or distribution network to continue to build out many more transmission lines or distribution lines. And yes, we do need that network build out, definitely. But we should try and encourage flexible assets on the system to behave in a way that increases the utilization of the network and doesn't mean that we get an overbuild of network, when actually we could use flexible assets and dynamic charging to push assets to behave in a certain way, and that can reduce the overall spend on network build out. For storage, because it's very happy optimizing around things like a flexible charge, what you would see is that essentially storage might charge in those injection point periods and in the middle of, say, a solar day, which helps the system, and it might discharge to meet consumption during peak times. And so again, that is something that helps the system, reduces costs for consumers, but also it assists the storage business case. This one is a chart that I think many people in the storage industry should be really interested in. And so here we've got the carbon savings in GB from the battery storage fleet. And so if you go back to 2021, most of the savings came from the frequency response market. And I was talking about this earlier. This was effectively that batteries are coming in and they're providing a frequency response service instead of gas units. And when you displace gas from doing that service, that effectively means that you don't have to run those gas units, and so you can save on carbon. Then in 2023, you've got more wholesale trading. And this is effectively charging when there's an excess generation of wind or solar, and then discharging into a time of system stress. And that means you don't have to turn on your gas units, and so you can save carbon. And that starts to grow from 2023. And then from 2025, you've got more dispatch in the balancing mechanism. And this is effectively saying, in that last hour before delivery, instead of relying on gas units for flexibility, you can rely more on batteries to do this. And this will save the system money. Now, currently, when consumers want to say they are zero carbon, they will buy certificates to do this. Those certificates, they come from solar generation or wind generation, and they're done on an annualized basis. And so that means you can take a certificate from the middle of summer and you can apply it to your winter evening and effectively say, my winter evening consumption is low carbon. In reality, obviously, solar's not generating during a winter evening. What's actually stopping the gas from running in a winter evening would be a battery system. And so what I'm really trying to say here is that as time goes on and we get a better certification system, which would essentially recognize the value of contributing at really difficult times and not paying money during the middle of summer periods where we have an oversupply of, say, solar or wind generation. For battery owners, this should be an additional revenue stream where effectively they are being paid by final consumers to help decarbonize their consumption during those winter peak hours. So expect that to change as the market design gets updated. Then this one's reasonably niche, but here are some examples of how people take their assets to market today. So an asset owner would work with an optimizer, and essentially they would split the revenue approach. And so this far left-hand side, this asset's making like 65 or 64K per megawatt per year. And in this case, you have the revenue coming in is 64K, and then you split that revenue with the optimizer. And so this optimizer in this case is taking 5%. And so that would be a typical structure. Then you might have a floor structure. And so that is effectively where an optimizer is guaranteeing you a minimum level. And so in this case, not much changes, but there's a slightly higher fee for it. But if we look at the world where actually revenue levels have dropped and they're not at 64K anymore, but they're at 32K, then you can see that the optimizer would be paying out to top you up to that floor. Okay. Then let's look at this last one. And this last one is something with an insurer. So you could have that same initial revenue. You could pay an optimizer a fee, and then you could also buy an insurance premium. And so you could essentially buy an insurance premium from a third party. And the idea is that that third party could step in and act a little bit like a floor to give you more security. So those are some of the route to market options that exist today. But the thing that I'm quite excited about is that Modo Energy has just had its indices FCA authorized, and this essentially sets up the ability for parties to use that index to structure deals in the market. And so in this case, what we're looking at is this kind of concept of a fixed for variable. And so if I'm an asset owner, I get variable revenues. So when the market conditions are good, I get very high revenue, and when the market conditions are bad, I get very low revenue. And maybe I don't want that, because that's quite a lot of risk. And so maybe what I want to do is I want to sell a variable position, and I want to buy a fixed amount. And so in this case, I could sell a variable index to a third party, let's say it's a trading house, and I could buy the fixed index back off them. And so if the revenues are really high, then I am essentially in a good place because my asset has made more money, but I've also sold the index to that third party. And in that case, okay, my revenues on my asset were high, but also I've sold the index versus a fixed revenue that I'm receiving. Let's say that fixed revenue is 60K. And so in this case, great, the merchant revenues were high, but I'm going to have to pay a chunk of money to that third party. Okay. And then in the case where the revenues are low, well, I'm going to sell to that third party at 40K per megawatt per year, but I'm going to receive that fixed amount at 60. And so what this is doing is it is a way of essentially de-risking your future revenues. So it allows you to get rid of some of the volatility in your future revenues and receive a more fixed payment from a third party. And the reason why I think this is interesting is because it may be possible to do this structure at lower cost than, say, an insurance premium. And it allows you to de-risk your position. So expect to see much more of that coming into markets over the coming years. And to end, I want to finish off talking about inertia. And so one of the things, one of the key parts of the market that we've been seeing is the growth of inertia markets. Here on screen, you can essentially see the concept of inertia. So on the y-axis, you've got grid frequency, and on the x-axis, you've got time. And on the red line, you've got a high inertia grid, and in the blue line, you've got a low inertia grid. And so essentially what happens with inertia is that with low inertia grids, when something happens on a system, you get a bigger deviation in frequency than if you had a higher inertia system. And so what grid operators like to do is to have more inertia on the system, which means that those frequency deviations are smaller. Looking at Germany and tying this all back to Germany, there's potentially a need for sort of 30 gigawatts worth of batteries, if they were the only thing providing it, to be online in 2027 in Germany. And the thing that's quite interesting on this is the revenue level might be something like 10K per megawatt per year. So those 5 points, stopping with inertia, which is a little joke, are a sample of a few of the ways that I think batteries can go beyond just the sort of energy and wholesale trading and frequency response, but they can be providing additional services into markets. And so the concluding remark for me is this one. We have not finished working out how to get the most from the storage fleet.